Okay, good morning. Welcome to the January 2011 presentation of Comprehensive Market Profile, Keys to Successful Trading. Couple of housekeeping notices here. We will try and take a break of about 5 minutes or so every hour. If I start to get wound up and I forget myself, give me a heads up. Somebody type in and said, Tom, you're killing me. Let's take a break. But I think it helps all of us if we can do this in bites of an hour. There's a lot of material. It's some of it's intensive, so let's try and stretch our legs every hour. And I'm going to rely on you guys to sort of help prompt me there when we reach that end of that hour. The other thing is, I've been doing an iteration of this seminar for years, and it continues to evolve. And one thing that makes it unique, well, there are several things that make it unique. One is that, we continue to add material to the seminar, and we also, each seminar is different, even if we didn't add material, which we do. It's materially the same, but the dynamic of the seminar is each one is different and is unique because of the participants in the seminar. And, I don't know what will be emphasized today more or less than was emphasized the last time we presented this seminar, but it will be different. And for that reason, there's a continuing value in coming back and seeing this seminar over and over. I'm looking at this list, and I know I'm looking at several of you that have seen this thing several times. And that's good, and that's affirming to us that you're continuing to get value out of this. And those of you that are taking it the first time, please, one of the, we record this, and you will have unlimited access to the recording of this presentation. But also, as long as you are an Alexander Trading member, you have the right to come to future live presentations of this seminar at no cost. We truly want you to absorb the material and to learn to trade it successfully. And the fact that so many others have continued to find value in the new presentation should give you an idea about the value of taking advantage of that offer, that as a member, we want you to come back and see the live presentations. An example of how we know that this is working and this is sticking is in something we've recently done in Alexander Trading is to begin advanced traders work groups. And basically what these are small forms of traders who are no longer in our live room. Anybody, they're welcome to go in the live room or stay in the live room, but these are people that are more advanced and understand the concepts that we're going to go through today thoroughly, and are now in the advanced stages of actually applying it and are really becoming experts in recognizing opportunity. And they're in the room basically sharing ideas like, okay, when I sit here and trade, I can't really follow more than 2 or 3 markets at most. So I miss a ton of opportunities during the day. Well, if you're in one of these advanced rooms, you've got, and you have 8 or 12 people in there watching different markets. It's incredible leverage in terms of exposure and opportunity. So that's one of the advantages. But the point of this is that the overwhelming majority of those people have taken this seminar, and most of them have taken it more than once. So this seminar that you see today is the base information. It's the base education that you really, really need. There's a lot of information in here. Some of it may seem to you, at least first time through, well, I really don't need to know this. Why is this relevant to trading? But it is. Everything in here is relevant to your trading. I'm going to spend some time this morning going through the evolution of market profile and how it has evolved through Settlemeyer's initial concepts through today. It's important that you know that. And over time, I think you will find that some of the things that you may not think are particularly important that you hear over the next 2 days actually are quite important. The other thing is that this is an interactive seminar. I don't want to just, I used to do these things live, and I miss doing them live because I can't see you and you can't see me. And so it makes it difficult for me to, actually makes it impossible for me to just look at a list. And I see John Ochnick up here, and John's eyes are glazing over. I know he doesn't understand if I'm looking at him, and he can. I can say, "Hey, John, are you with us here? Are you catching this?" So if I'm losing you on something, or you drift off and you need me to repeat something, then let me know, because it's important for us that you guys get this. We want you as long-term clients, and the fact that you're making the commitment in terms of time and money to listen to this seminar. You've got this is the tip of the iceberg, but it's the base of that iceberg, and everything that we do follows from the base that we're going to set for the next 2 days. So I'm excited to have all of you here, and in particular the new people who have found something that is, hopefully you'll see that this is very different. And at the end of 2 days, one thing that we tell people is they'll never look at a market the same way again. And I don't think I've ever had anybody that didn't after listening to this seminar for a couple of days. So ask questions. There's a Q&A. You can type into that. If you enter things into the chat, I can see them there too. The question and answer, either one of those things. When you type something in and you post it, it rings a bell that I'll hear, and I'll try and get to it. So we'll get going, and we'll go for about an hour, and we'll take a break. Why are you here? Hopefully you're here for the right reason. And the wrong reason to be here is that you think that over the next 2 days I'm going to give you some sort of magic that is instantly going to turn you into the trader you can be. And that's not going to happen. There is no such thing as magic in trading. That is sort of one of our themes. There's an overwhelming tendency in the trader education space to sell magic, and the reason is that there's such a demand for magic. The sad reality is that trading is a profession. Trading is a profession similar to other serious professions that have a learning curve and have material that has to be learned, such as, well, you name it. Physicians, engineers, attorneys, teachers, bricklayers. I mean, unfortunately, the trading advisory space suggests that it's easier to learn to trade than it is as it is to lay bricks. And it's not just the trading advisory space; it's also the entire industry is set up to present, in my mind, a false view of the reality of trading. And this industry is sort of unique in that way, in that everything in the industry is designed in the interest of the industry itself and to the detriment of its customers. Now, not too many industries can get away with that. I'll give you an example. The U.S. automobile industry almost killed itself in the 1970s because the product became so bad that its end user began buying products from other countries. And it's still, you can make the case the U.S. automobile industry is still recovering from that because its customers had an alternative and they exercise that alternative. Well, in trading, you have a fresh group of traders every year. And there's a never-ending supply of new meat, so to speak. And the game in the trading, in the entire trading industry, I'm not talking about just the trader education space, but the exchanges and the brokers, is transaction. It's built on a transaction model. And the more you trade and the more transactions, the better the industry does. And so that is how everything is driven in this space. And you need to be aware of that. What is in the best interest of this industry from the top down is not necessarily in your best interest. The reason for disclaimers is not to protect you from your capital. The reason for disclaimers and for margin requirements is to protect the brokers and to protect the exchanges. I can go on and on about that. Now, the other thing that I always tell people in seminars and webinars, whether they're live or they're recording, is to listen very carefully to everything that I'm going to say today and that Harris is going to say when he gives a presentation tomorrow. Listen very carefully to what we have to say. Actually, it's being recorded, so I can't deny anything that I'm saying here, nor would I, but the point is I want you to pay very close attention. And this may be the most important piece of advice I can give you. This may be worth, the next 90 seconds may be worth what you paid for this. So I want you to pay close attention. I want you to make notes. And I don't want you to believe a thing I say. I don't want you to believe anything Harris says. I want you to disprove what we're telling you. I want you to be skeptical about what we're telling you. Disprove it. Prove us wrong. And then let us know. And then, but I also want you to apply the same line of reasoning to everything that you use up to this point in time. All the lines you see on your chart, why is that line there? Disprove it. Don't assume that just because somebody sold it to you and you paid some ridiculous amount of money for a colored line on your chart that it works in your trading. Be honest with yourself. Look at all the books over there to your left or in front of you, wherever your bookcase is in your office, and look at those books. Just because somebody writes a book doesn't mean it's valid information. Question the information in that book. Where did it come from? Don't believe it. Disprove it. If you will go through that process with everything that you hear from us today or going forward that you hear from us, if you will apply that process to us, but also to everything else that you presently use in trading, it will be the most helpful exercise that you will ever undertake in trading. So with that, we'll continue here. Trading is a very difficult business. It almost always proves to be daunting to anyone that tries it, attempts to trade. Our clients are extraordinarily well-educated, successful, self-motivated, financially secure people. And I think our clients are not that much different than the pool of clients. It just doesn't stand to reason that they would be. And so you ask yourself, okay, you've got this incredible pool of bright, successful, self-starting people. And we know from experience that most traders fail. I mean, the industry figure is, you see thrown around as 90, 95%. Now, that's the industry figure. So why do so many capable, bright people that have succeeded in everything they've ever attempted to do come into something and they all manage to fail at it? Statistically speaking, they basically all fail. Why is that? Well, my idea about why that is it's because what has made them successful in other areas of their lives almost ensures their failure when they come into trading. And let me explain. When you begin school, when you pre-kindergarten, I have an 8-year-old son. Actually, I have 4 children. My youngest is 8 years old, and he especially, he started preschool, he goes to kindergarten, he goes to the 1st grade, he goes to the 2nd grade. So he is beginning to learn a learning model that he will use and he will apply the rest of his life. So he goes to school and his teacher explains something to him, gives him a spelling test, he learns some new words, he comes home, He practices with me and his mother learning his words. He goes back. He has math tests. And then, he takes a test. He turns it in. The teacher corrects his test and explains what he got wrong. He comes home. We work with him, make sure he understands the problem or he can spell the word now. He goes back and he repeats that process. And this is the same process that my oldest child is going through, and she is in law school. So both my second grader and my oldest child is in law school still learn the same way. They have learned that they go to school, there's an expert there. The expert has valid information that is used, that is the basis for building on their knowledge. They take a test, they take it, the expert grades it, the expert gives it back to them, and they move forward. So what do? Okay, we take that information and we become engineers. We start as, we're working for a company, then we start our own company, and then we sell that company, and we're sitting there, okay, what are we going to do? Well, let's get into trading. Trading is intriguing. The people managing my money are losing it. I can lose it just as easily as they can, and I'm just as smart as they are. So I'm going to learn to trade. So what do? I do the same thing that I did when I was 8 years old or when I was getting an advanced engineering degree. I go find an expert, and I get on the internet and I see this guy is a trading expert, and he's written a couple of books, and he's got a chat room, so he's an expert. So what I'm going to do, I'm going to get in here and I'm going to see what the expert has to do, and I'm going to learn to trade the same way that I learned how to become an engineer or a physician or a teacher or a lawyer. And so I get in there and I find an expert, and I get the material and I read the book and I start to apply it, and I'm having trouble. And I go to the expert, and the expert says, well, what you need to do, you need to come to my seminar that I'm giving on Saturday and Sunday, and I'm going to give you all the answers. So I go to the seminar on Saturday and Sunday, and I listen and I pay attention and I make notes, and I go back and I try to apply it, and it doesn't work. And I keep trying, and now I'm losing money and I'm losing time and I'm getting frustrated. And, then I said, well, you know what? I just got my new Stocks and Commodities magazine. And I was looking through there, and there's this guy in there, and he has this unique system that's different than the oscillators that I use, and he uses magic numbers. And I'm gonna try that, because this isn't working. It must be something I'm doing wrong. It just doesn't fit my personality. So I go over to this expert, and then I take his seminars. I buy all his books. I get in the chat room where he's got all these people calling trades all day long. Some, everybody's making money but me. And I follow that. So I go through this process, and I'm not exaggerating when I tell you that I have clients that have been doing this for decades. And it finally dawns on them, some of them, not everybody, that, hey, you know what? Maybe it's not me. Maybe it's not the material. So I think that the majority of the cause of the incredibly poor success rate of traders is not because of the traders. It's because of the material that they use to try to apply to trade, and they try to learn to trade. So what we have done, what Harris and I are doing, we have put together material that we are going to tell you is valid. Now, again, just prove it wrong. But one thing you'll never hear from me or anybody that's associated with me is that trading is easy, that it doesn't require an investment on your part to educate yourself, and it doesn't require a lot of hard work and frustration. And this is the first step for you if you're an Alexander Trading client, is to listen to the material in this seminar, and it is valid material. I can tell you that with confidence. Now, again, I'm quite happy for you to work on it and prove it not valid. We have a number of clients that are quantitatively oriented. Harris, for instance, is a math major. We've got other guys that are PhDs in various scientific fields, and we do get challenged, and it helps us. So we encourage you to give us feedback. If you want to question what we're doing, or the statistical veracity of something we're doing, let us know. It helps us, and that in turn helps us help you and help help all of our clients. So we encourage that. Now, you are here because you are trying to learn to trade, and you are, at least implicitly, you've made the assumption by investing in this that you think this is valid, and that's good. But going forward, from this moment forward, you've got to question everything you're doing and if it is valid or not. And that's going to be an underlying theme that you're going to hear today over and over and over. So now, somebody just posted something here. All right, T-Bun Trevor just posted something that I think is interesting. He says, hopefully this is the first step unless you're like me and had to unlearn a bunch of crap as well. Finally got around to taking the last red-blue indicator off that last little bar chart in the corner. And you know, this is a process, guys. I mean, I don't expect you, and it wouldn't be normal if you scrap everything you're using now and start, you know, applying the concepts that we're going to teach. I understand that. All I'm trying to do, and if I accomplish this, it's a lot. I want you to think about what you're doing and why. So, you know, don't expect you to believe me. I don't expect you to take all the oscillators off your screens right now. You will eventually. I promise you will. But you know, do it in your own time. Now, one of the myths about trading is that you have to be able to predict to trade. And this is something that traders are obsessed with, and it's something that because the pool of traders think that trading is about predicting, and it's not. And the trader education space is heavily influenced. The majority of trading educators are either explicitly or implicitly telling people that they have something magic that is going to help them learn to predict. And trading is not about predicting. Predicting is one of the most dangerous mindsets you can get into for a number of different reasons. Now, I want to ask you guys, do you think it's necessary to predict market direction to make money trading? How many of you think it's necessary? Now, those of you that have seen this a few times, hopefully you know the answer. But you guys that are new, I'm just throwing that out. Do you think it's necessary to predict market direction to make money trading? Okay, here are a couple of interesting points. Elena, bias is necessary. I think an assumption, which is maybe another word for bias, is necessary. We'll get into that. And Daniel, you're new, so you know the answer, but it's hard to buck my Elliott Wave training. Yes, if you have a background in Elliott Wave, and Elliott Wave is the poster child for predicting. And I am an Elliott Wave expert. I used Elliott Wave. Actually, it was the first form of technical analysis. I've been trading 26 years. The first form of technical analysis that I used. I almost went to work for Bob Prechter in the very early 90s. So I'm an expert in Elliott Wave, and I traded it or used it for years. And it's not tradable, but I can give you a million reasons why. Now I can break down a chart in Elliott Waves and give you alternate counts and primary counts and reasons and rules with anybody. And I don't, you know, it just doesn't even enter my thought process anymore. But it's a perfect example of predicting and getting in a predictive mindset. What you've got to do to trade is you've got to find, what are you trying to do when you're trading? You're trying to make money, right? And it's not about predicting the end of a move. You want to be able to, Elliott Wave is an attempt to make order in the market, right? I mean, that's ultimately what it is. It's an ordering scheme for market behavior. Is that accurate? I mean, Daniel, isn't that basically what Elliott wave is? If we're in a third wave up, then the move should be strong and relentless, et cetera, et cetera. Or if we're in a fourth wave triangle, the trading is going to be choppy, et cetera, et cetera. So Elliott wave is an attempt, and it's not that much different than an oscillator. It's an attempt to impart information about what the market is doing. The problem with especially people that use Elliott wave is they get in this predictive mindset and they forget what they're there to do, which is to make money. Okay, so how can one make money unless you can successfully and consistently predict market direction? Anybody? Okay. All right. What is the? And we're gonna cover this. These are important questions, and these things are going to be answered. But what is the one absolutely necessary ingredient every single trader must have without exception to succeed? And think about that now. Okay. So how can we make money trading unless one can successfully and consistently predict market direction? Is it necessary to predict market direction to make money trading? These are questions for you, and we'll have the answers. Now, here are some ways that people think that you know. This is how most people think that you make money trading. Either work for Goldman Sachs, work for the Fed, or some magical device that I'll just throw into referring to as the Force, as in Star Wars. Far too many traders out there, whether they realize it or not, are trading by the Force. And you know what? You really don't want to be trading by the Force. It doesn't work. It might work in Star Wars. It doesn't work in trading. And I don't think any of you work for Goldman Sachs, and I don't think any of you work for the Fed. So this is the one thing that every trader has to have, without exception, in order to succeed: an edge. What is an edge? Somebody tell me what an edge is. It's a statistically proven advantage. Yes, it's a method that provides over a series of trades, a statistically valid series of trades, a positive expectancy. So that's where you want your focus to be. You want your focus to be on developing a methodology or developing a trade plan based on a valid methodology that provides a positive expectancy over time. That doesn't necessarily mean you have you've got to have 70% winning trades. That's not what an edge is. As most of you, or a fair amount of you know, actually all of you that are clients, present clients know, you can have spectacular success at an incredible positive expectancy trading with far less than a 50% win-loss ratio per trade. So you really want to reorient your thinking away from predicting and into focusing on what's important, and that is trading an edge, identifying an edge. So predicting puts you in a mindset that's very dangerous. It's a distraction away from the purpose that you're trading. I trade to make money. Now you've got to be careful. There are people that are gamblers, or there are people that are thrill seekers. But if you're trading to make money, you don't want to be in a predictive mindset, and your focus needs to be on developing an edge. Also, predicting puts you in a difficult psychological state, because you tend to think of in terms of, okay, I'm right if the trade makes money, I'm wrong if the trade loses money. And it's nothing like that. It's about the process. I take trades all the time that don't work. The question of whether or not it's a good trade really has nothing to do with whether or not the trade made money. Nothing. Now, this is important. When we believe something, we are biased towards information that supports it and against information that does not support it. So what I want you to believe is to have that mindset that's neutral in terms of your beliefs, and use critical thinking and focus on developing an edge. Does the information you're going to see for the next 2 days help you develop an edge? If it does, it's invaluable information. If it doesn't, it's worthless. So the auction market principles that you're going to learn, the basic auction market principles and some of the advanced concepts we'll get into, provide the basis for identifying a consistent edge. That's what the focus is on. What we're going to do today and tomorrow is to show you a worldview, to present to you a worldview of market behavior that is incredibly consistent and incredibly objective. I'll tell you a story. I was talking to a client yesterday, and actually I'll tell you who it is. It's Alan Spohr. And Alan Spohr has been a client of mine for 2.5 or 3 years now. I met Alan actually giving this seminar in San Francisco about 3 years ago. And Alan he fits the demographic of our clients perfectly. He is a very bright guy. He has, he built and sold his own business. He's an active trader. And we were having a conversation yesterday because Alan is heading up an option program that we're beginning. Hold on, Harris. Guys, excuse me. What do you need? You need to be the host. Okay, you're the host now. Okay, so anyway, I was talking with Alan, and we were talking about the option program we're putting together, and he said something to me that meant a lot to me. He says, Tom, one thing about what you've done over the years is that you are so consistent. And, I've been listening to you give these seminars, and I've been reading your work, and I've been taking your reports, and I've been listening to you in the trade rooms, and you're consistent. And, that was very flattering, and it was also very affirming, but I really can't take credit for that. I'm consistent because I have something objective that lends itself to consistency, and that's what this is. And that's what you have to be consistent as a trader. Now, I realize we're discretionary traders. We're not mechanical traders, but you have to be consistent even as a discretionary trader. Otherwise, you are random. And Harris can explain this very well and will tomorrow. You can't be random. Randomness produces random results, and you will lose all your money if you're a random trader. So what we're doing, you're going to learn a perspective, a worldview that gives you a trading perspective that's oriented toward the goal of consistently and objectively identifying opportunity. We're not trying to predict the beginning of the third of a third of a third of a third of a third, or the end of the fifth of the fifth of the fifth of the fifth. It's about identifying opportunity and doing it consistently and objectively. And opportunity, that's all fine and good, right, Tom? But opportunity is further defined and identified by market condition and trade location. Now, when I asked before the trick question, do you have to predict market direction to identify, to make money trading? Some of you sort of said, well, no, but you got to have a bias, or you have to know what the trend is, etc. And this is the answer to that. We want to know what the market condition is, and there are times where it's extremely clear what the market condition is. And if we know what the market condition is, then that can help us to identify the areas within that market, trade location, where we want to be entering trades. And those are the areas that provide an edge, whether we go long or short. This is a unique methodology in that if you're consistent and objective and you get good at identifying where to trade, it doesn't matter if you go long or short. In the long run, you will make money. Now think about that. Some of you guys taking this for the first time may not understand that. But I'm going to repeat that again. This is a methodology that focuses on identifying market condition, which leads to the ability to identify trade location. And it's where you trade that determines your expectancy, not whether you go long or short. Now, that said, there are ways to determine a bias and to form a logical and consistent assumption about market direction, but not always. Sometimes, and we actually had a recent trade maybe we'll look at later, sometimes you're in a trade location and it's a coin flip. Do I go long or short here? But you still want to take a trade because of the positive expectancy, long or short. And I'll give you the specific example. Last week, the euro was in a certain trade location, and I think Harris actually went long. I went short. And so one of the rooms that I was in went short, and Harris's room went long. Well, Harris was right, and I was wrong, and the other room was wrong. And not only were we wrong, we were spectacularly wrong. But that's good. If you're wrong in this, you're usually going to be wrong in a big way, at least in terms of the magnitude of the move, not in the amount of risk that you take. So we took a small loss for a potential large gain. Harris's group, and he was in the live trade room in a different room, they took a small amount of risk and had a huge gain. So we took a small amount of risk and we had a small loss. We missed the big gain because we just guessed wrong. Our assumption was wrong about the direction the market was going to move. So it's not about predict. Now, Harris was right and so were we, because it wasn't the result that made us wrong or right. It was the trade location. So there are times where, market condition and trade location trump everything else. You've got to get out of this thought process that this little bird that says, I got to know which way the market's going. How do I know if I go long or short? Well, you've got to reorient yourself to identifying a trade location. Harris, do you have what you need? Harris?
Yeah, I'm here.
Did you get what you needed from me?
Oh, you made me the host. Okay, yeah, I can send it. Okay, good.
And then don't
I got what I need.
Those back before you leave, okay?
Okay, I'll give it back to you. Okay. But let's do it. We'll change it at the next break because I don't want to disturb your your sharing.
Fair enough. So what we want to do, as opposed to predicting, we want to learn to identify market condition and trade location that lead to an objective, consistent edge. Your focus will naturally be oriented to the goal of a trader, and that's to make money trading. So look at the stuff on your screen and look at your books and put it through that filter. Is this helping me make money trading, or is this magic? Why? This says this in this book. Why? What's the basis? Is there some basis in logic? Just because somebody says they're an expert doesn't make them an expert. So being right is framed as consistently taking trades with an edge, being able to identify times and places where there's a positive expectancy. A losing trade is not being wrong. This is not magic. It depends entirely on an understanding of the market based on information the market alone provides. All the stuff that you see on your screen, all the lines, all the indicators depend on it. They're sitting there waiting for the market to begin trading again Monday night. Indicators don't lead the market. Indicators are the behavior of that indicator, any indicator, is totally dependent on the behavior of the market. So think about this. If then we can learn to read the market and to identify certain common characteristics in an objective manner consistently in the market, that's really what we want to learn to do, isn't it? You know, why do you want to take something that is derived from the market itself or is a second or third derivative from the market itself and focus on that when what that does depends on what the market does? So why not just focus on the market itself? So that's the message. I want to get you away from the predictive mindset. Now, there is one thing about the market that can be predicted, and this is important. This happens as sure as the sun rises and sets. A market will cycle from horizontal to development to vertical development and back again over and over in all degrees of time. This is what you have to know, you have to understand, and you have to believe to be able to effectively trade the methodology we teach. And I'm going to painstakingly show you examples of this in all degrees of time in a number of different assets over and over for the next 2 days. And even if you're in the advanced trade rooms that people are in now, it all defaults back to this. This is the one thing you can predict about a market. A market will cycle from horizontal development to vertical development and back again over and over in all degrees of time. Okay. Methodology. Most traders and the entire trading industry focuses on this. This is the methodology for most traders, the DOT. It's a setup gimmick, and we have setup gimmicks, okay? But this is a moving average crossover. This is a divergence on your MACD. This is a Bollinger Band that expands or narrows. This is any number of setup gimmicks. This is what the market focuses on. It's the DOT. 95% of the traders out there are searching for the DOT. And because they're focusing on the DOT, they miss this. They don't see this. Giampolo, I'm going to answer that question as we go through this, okay? So this is the DOT. Well, the focus, this is immaterial. This will kill you. Focusing on this will kill you. What I want you to do is to focus on everything around the DOT. We don't want you focusing on the DOT. Now, when I first, I've been in the trading industry for 26 years. I've been trading for 26 years. And I've had I've worn various hats. I was started as a stockbroker. I worked for major Wall Street firms. I've done institutional trading. I've traded large accounts for individuals. I own my own brokerage, my own futures commodities brokerage. And over the years, I would have people that I would come in contact with that would say, "Well, can you help me with my trading?" And I'd say, "Sure." And this was on an informal thing before I began Alexander Trading. And so what I would do, I would say, "Okay, I'll help you, but you gotta, what are you doing? I tell you what, send me a snapshot of your screen so I know what you're looking at." And I would guess that most of you, if your screen doesn't look like this now, has looked like this at some point in your trading career. And this would be the typical snapshot of a trader's screen I would get. Now, this is a 1-minute chart, and I would get charts like this that were, tick charts, 34 tick charts, and some, fib number tick chart, 55 tick chart, whatever, 34, etc. And then you've got stochastics, you've got CCI, you've got MACD, RSI, percent R, oscillators that have been, sold to people that are basically a stochastics that have been repackaged, redefined, and they're different colors. Pitchforks, Elliott wave, fib retracements. And if you look at this, there's no way in the world you can make a decision to make money. But all of these things, everything on this chart except for the price, is an attempt to make sense of the price itself. There's an implicit there's an implicit understanding, I should say, on the part of the trader that they need to understand the market in order to make money, that just the price bars don't help. And these oscillators and the magic numbers are the attempt by the trader to find information that they know they're lacking about what's going on in the market. So this stuff doesn't work. I wish it did. I've tried it. I would try it. If you guys can show me and prove to me that it works, I'll use it myself. And one thing that I always tell people is, look, if you're using something and it works, forget what I say. All that matters is if it works. But be honest with yourself. Does it really work? Have you tracked it? Are you keeping records? Just be careful. Now, what we're going to do today is we're going to replace all the stuff on this chart. And in replacing it, what we're going to do is going to give you something objective and consistent that is going to give you an incredible insight as to what the market does, what condition the market is trading, and where to trade. That's really what you want to do when you start putting this stuff on your screen. Those are the questions that you're trying to answer. But this stuff doesn't answer the question. This stuff obscures and takes your focus away from what you really want to be doing, which is making money trading and identifying trade opportunity. And the way you do that is to understand, have a valid way to understand what the market is doing and why, and where to place trades. It's pretty much that simple, that have an edge. So what you want to do, hopefully you're already beginning to do, I hope I've made some of you very uncomfortable. If you're listening to me and you're starting to get a little uncomfortable, it's probably a good thing. What we do requires that you change your perception about a number of different things. Highly successful people in almost any endeavor have a vision, and that's another way of saying that they have a different perception of things. There are successful people, not all physicians are held in the same esteem by their peers. Not all doctors are held at the same perception, or held in the same esteem among their peers, et cetera, et cetera. And the ones that are different just have a different way of viewing things. So if you're going to be different than the 95% of traders that trade, you're going to have to change your perception about a lot of things. And some of those things, we'll get into that a little bit. We want you to change your perception about market behavior. We want you to understand that you can't put a bunch of lines on your screen and expect to have a valid and objective and a consistent way of viewing what's going on in the market. You're going to need to change your perspective. Those of you that have some experience about market profile or with market profile, you need to change your perception about market profile. We are not market profile traders. And if you're with us for very long, you won't be a market profile trader either. We are auction market traders. We trade an auction market concept, theories about how an auction market develops. And the market profile graph is an artifact of the auction market process. It's the visual artifact defined and constrained by time that can be a very useful tool. Bar charts can be an extremely useful tool. Actually, there are times when bar charts are more effective at helping us to identify what is going on in the market in terms of market behavior and market condition. Is it horizontal development? Is it vertical development? Where do I trade? What levels am I looking at and why? Than a profile chart is. So we're pretty agnostic as in terms of trading the market profile graph. They're like everything else in trading for my entire career. You know, I've seen magic cycle through many different things over the past 26 or 27 years. When I was in the mid 80s, there was a guy named Wells Wilder, and Wells Wilder wrote a couple of books that were extraordinarily popular on what he referred to and really what people consider technical analysis today, which was basically built around oscillators. Wells Wilder, I think this is accurate, was the quote-unquote inventor of RSI. And he wrote all these books about RSI and a number of other technical, quote-unquote technical indicators that were derived from the market. And that became just incredibly popular. And there, you know, cults build up around these things. About 10 years ago, there was this cult that built up around CCI, and it was the most nonsensical thing I've ever seen in my life. But these, you know, things, you know, rotate through trading. And I'll tell you this: market profile is rapidly entering the cult status. You've got these people that think that there's some magic to a market profile graph, and that magic, let's put some magic lines on this graph, and all you need is to buy this software and get these magic lines, and you'll understand what's going on with and how to trade market profile. Well, you're not, first of all, you're not trading market profile. A market profile graph is a form of a graphical artifact of what's going on in the market. It's chronologically constrained to a specific time frame, and it's one view of a visual view of market behavior. But it's nothing more or less than a tool. And again, we're auction market traders, not market profile traders. Now you're gonna see a lot of market profile graphs, and we're going to talk about it. We use it, but you need to understand it's a tool. It's a means to an end. It's not an end in itself. That's excuse me. That's very, very important. And we're going to change your perception about how to trade. For instance, you've got to get over this search for something that's going to give you 70% winning trades or 60% winning trades. It's not going to happen. It's just not. That's not where your focus should be. Now, if it happens over time, that's great. But I don't want you to think that you have to find something that's going to give you 6 out of 10 winning trades to make money trading, because you don't. There's something far more important for you to focus on initially that will keep you in the game and keep you from blowing up. If you focus on having a high percentage of winning trades, you're extremely likely to blow up. Now, I know that sounds ironic. I would rather have you focusing on having much, and we'll get into the details of this later, but the focus is going to be on identifying trades from where you have an outsized reward to risk, where you're entering a trade where the market is more likely than not to have a larger than random move. In other words, it's a move that exceeds the typical noise in the market. Okay, why change your perception? because this works. That's the bottom line. I've been trading quote unquote market profile pretty close to since its initial inception when Stottlemyre first posited this back in the 80s. And it became a cult then. There's still a cult around Stottlemyre today. I have a tremendous amount of admiration for Stottlemyre. I know Stottlemyre. I've spent a lot of time with Stottlemyre. I've read all his books. I have articles that are out of print, and we're going to get into some of this a little bit later. He is a visionary genius, and he remains so today. But a lot of what he initially posited, and we're going to get into the history of this and why, etc., a lot of his early concepts that people attempted to trade and that he attempted to teach, quite frankly, weren't valid to begin with. And then there are some of the concepts, the early market profile concepts, that are simply dated, and because we have the trading world has changed so dramatically that things are different. And I'll give you an example. Volume. When Stottlemyre first posited this concept, the profile graph is a proxy for volume. Well, now we have real volume. I mean, we get it. Back in the 80s, when I first started trading, and when Stottlemyre was positing these concepts, you had to wait a day to get volume. You didn't know what the volume was until the next day, and it flowed through the exchanges. So there are a lot of concepts about market profile that people, and actually most quote-unquote market profile services and most market profile traders are still trading a lot of those invalid concepts. So you've got to change your perception because of that. We want you to change your perception because this is truly unique. It's extraordinarily robust. It's consistent. It's objective. It can provide context that can help take any present valid approach to another level. Now, we have people in our trade room that are extremely sophisticated traders that have been some of whom have been trading longer than I have. That's a long time. Some of I'm looking at this, and I know at least one of you has been on the floor for 30 years. There are things that are valid out there that are not quote unquote pure auction market concepts, but everything out there that is valid and has a connection to these concepts. Believe me, we have a guy in our room that he's a mathematician, a statistician, and he's worked in his own systems, and he works with volatility, he works with ranges, and had a conversation with him the other day, and he's in one of our advanced trade groups, and he likes our work because it helps validate his work and vice versa. So this is something that can take anything that is valid to another level, because if what you're using is valid, it will fit like a glove with this. It almost has to. Now, I want to explain what robust means. I'm using robust. I'm sort of borrowing that from the systems people. And the holy grail of system development is to have something that's robust. And what that means is that they back test. If you develop a system, you have to back test, and then you have to take the results of that. You have to apply the rules that you've developed on an out-of-sample set of data. And if you get positive results, your system is considered to be robust. Now, this is an oversimplification. The gist of it is that something that's robust works across different markets. Now, this is the most robust perspective on markets that's you'll ever find, and I challenge you to challenge me on that. This is a methodology that allows you to view any market in any time frame the exact same way and trade it the exact same way. Now that's almost a ridiculous claim if you think about it. But again, remember I said that, and then prove it wrong. Okay, it's 10 o'clock. Let's take a break, guys, okay? Hey guys, hear me okay? Yeah, looks like I'm recording. Okay, let me find something here. Here we go. All right. Now, one of the, we are in interesting times, as they say. And I'm sure because of the internet, if you're like me, and I do this, I love to get on the internet because, I am, trading is not just a profession with me, it's an avocation. I love it. So I'll get on the internet and I'll look at different blogs and read this and that. And, I have buddies that will send me stuff. And, I hear a lot of angst and anxiety out there because the market's not acting the way it should. Why is the market, and in particular the stock market, this is the most disbelievable market in history. Why is the market going up? It's different this time. I don't understand this. The market should be going down. This shouldn't be doing that. It should be doing this, et cetera, et cetera. And again, and some of these sites are, some of these blogs are by people that are extraordinarily bright, but they're stuck and they're brainwashed by things that don't work, specifically fundamental analysis. I put fundamental analysis and technical analysis in the same category. 99.9% of both of those quote-unquote disciplines are bunk. What you're seeing, our methodology, is not technical and it's not fundamental. Actually, I could make the case that it's the most fundamental form of analysis of all, and we'll talk about that. But what you're seeing, guys, is something that it's working just as elegantly and as tightly as it ever has. Now, the chart that you see on the screen, this is let's see, I think these are quarterly profiles. In other words, each profile unit, each group of letters, this is a profile graph, represents a quarter of trading. So this happens to be 1929 through 1930. And this was the third quarter in 1929 leading into the 1929 market crash. And if you look at this, you're going to see, I want you to look at it, and the takeaway from this, I want you to notice the shape that you see here. And again, the profile graph is an artifact. It's a gross, blunt artifact. It's a way of defining visually auction market behavior. But it really does it quite consistently, especially in your longer term time frames. It filters out noise, but we'll get into that. So this is 1929, 1930. This happens to be the Dow, okay? Now this is 2008 and 2009. These are year profiles. This was 2007. So you can see we formed a profile here, and this is the year 2008, leading into 2009. But you can see, look at January of 2007, leading into 2008, and if you go back, it's a different time frame a little bit, but you get the same auction market that's forming. The reason these shapes are the same is because the underlying process that creates the shapes is the same. That's extraordinary. Now, think about this. During the market crash in 1929, what happened from the midpoint of 1929 into 1932? That 3-year period of time was a time of some of the greatest change in the history of this country, socially, economically, in terms of government. It was extraordinary, the changes that took place across the period of time from 1929 to 1932. People were, there was incredible upheaval, socially, financially, and in government, and from 1929 to 1932. Now, does that sound familiar? It should. I mean, think about the incredible changes that have occurred since the top that occurred in 2007, in October in 2007, into the present. We have extraordinary change underway, socially, economically, and in government. So it's remarkable the change that occurred back 80 years ago, and it's being mirrored today. But you have people today, just as you had people back then going, oh, the market's different, it's ruined, it's being manipulated, it's being controlled. Well, you have the same stuff being said today. And you know what? It may be, but there's something that can't be suspended. I don't care who's buying and who's selling. I don't care if it's the Fed buying and the Fed selling, or if it was J.P. Morgan himself back in the 1929s, 1930s buying and selling. It's still the facilitator of that buying and selling is an auction market, and that's what we're trading. So think about that. That's what makes this incredibly robust. Now, what this is the 1932 Depression low. And this is not this happens to be a year configuration. This is from April of 1932 to April of 1933. So you've got the same auction process in effect. The Dow was actually, this print here is 39 and change, as in 39.10. But you had the same exact process in this price range from 80 to 39 that you have in the Dow now, from say 11,000 to 12,000. It's the same exact process. The same concepts apply. This is the low in July of 2002. So this is information that is from May 2002 until March 2003. So this is not quite a year, but this is the low in 2002 that was the low until the March low back in 2009. But if you look at this, this was sort of a bottoming process coming out of an incredible 3-year decline, just as this was a bottoming process coming out of an incredible 2-year decline. And it's the exact same process that's in play, the same auction market, the same facilitator of trade, regardless of the catalyst of that trade, regardless of who the buyer and the sellers are. The media, the mechanism is the same. The mechanism is the auction process. Now, it's also, and this is something else that's unique to this, this is a methodology that is robust across all market conditions and volatility ranges. Just last week, and this is something else that has been going on since the beginning of the time of markets, and certainly over my 26-year career. There is a constant attempt on the part of the people I refer to as the smart people to quantify the market. You know, you've got all these physicists and guys with advanced degrees in statistics and mathematics, and they want to model the market. They want to create an equation that they can just push buttons and things will work. And they do. These guys always come up with something that works, and sometimes it works spectacularly well. But without exception, all those systems eventually fail. And a lot of times, an uncanny number of them blow up. A perfect example of that is long-term capital management. You guys, if you don't have the book When Genius Failed, you need to get it and read it. There were 2 Nobel Prize winners on the management team, founders of long-term capital management, in esoteric applied mathematics, and one of them was I can't remember if it was Scholes or Black, but one of the guys that was won a Nobel Prize for option pricing modeling. And they almost blew up the financial world back in 1998 because the system that they used basically blew up. The volatility changed, the correlations that they were using between assets and and between interest rates changed, and they blew up. Well, this is a methodology that is dynamic, and it self-adjusts. It self-adjusts the volatility, for instance. So that's the specific condition here. Now, this is October 2006 to March 2007. You guys know what VIX is. It's a measure of volatility. That's all you need to know. That's the takeaway. And back in this period of time, volatility was in a range between 10 and 12. Now, back in the fourth quarter of in 2008, we had an incredible amount of volatility, and the VIX reached as high as almost 90 for a period of time. Now, there have been spikes in volatility throughout my career that may have been greater than, say, 90. And an example of that was back in 1987 when the market crashed. And I sat and watched every single tick of that. But never, to my knowledge, at least in our lifetime, anyone listed in this webinar, have we had such an extraordinary extended period of volatility. We had 6 months of volatility that was incredible. And a lot of hedge funds blew up. It used to be that if the VIX exceeded 30, you were within days of a buy. And so all the quants devised these models. So when VIX hit 30, they started buying. Well, 30 is high until VIX passes 40, and then 50, and then 60, and then 70, and then 80, and then it stays there for months. So that didn't work. The model didn't work. It was not as robust as they thought it was. Now, this is a profile from October 6, 2006. This is one day of trading. This happens to be the December S&P Mini in 2006. The average true range on this day was 1040. And this is the auction that occurred that day. This was a 7.5 handle range. In other words, the S&P moved from low to high in the day session on October 6, 2006, 7.5 handles. And this was normal for, a long period of time, not just one day. This is just an example of a day. At a 7.5, a 7.5 point range that day in the S&P from low to high. Now, this is another day. This is October 24, 2008. The average true range was 70. The VIX was almost 80. The range this day, was 57 S&P points. 57 points. So, but look at this. You had the exact same process in this volatility as you did in this volatility. The exact same process was in effect. So you were looking for opportunity based on something, on the exact same things here that you were here. So you were automatically adjusting for the incredible difference in volatility. There is nothing else out there that I'm aware of, and if there is, please let me know, that is as robust as this, or that would allow you to change, to trade such incredibly disparate ranges in volatility using the same objective, consistent approach. Now, bear with me. Let me catch up. I'm going. You guys will be getting a manual, by the way. So I have the slide presentation. I have the manual that I'm going through. I don't want to leave out anything, so I have to pause once in a while to catch up my manual with the slides and make sure you guys are getting what I think I'm showing you. Okay, we're going to talk about something that's important here. And this may come into the category of why are we learning this, but over time, I think you'll appreciate it. And it speaks to the evolution of the concept. One second here. I'm going to take a sip of my coffee. My throat's getting a little raw. Okay, what is market profile? Let me give you the background now. Now, we've already covered what market profile is. A market profile is nothing more and nothing less than a graph. It's not that graph is not going to do you any good. What you have to understand is the process that creates that graph, and that process is the process of how an auction market develops. Now, we're going to talk about Peter Stettlemyre for a minute. Stettlemyre is a guy that was a floor trader. And Stettlemyre is now in his late 70s or early 80s. And he's really a fascinating person. He was on the floor of the Chicago Board of Trade as a floor trader I think he was in the grain pits. And he started there in the 1960s. Now, Stettlemyre's background, he grew up on a farm in California. And he and his brothers and his father and their ranch hands all farmed this evidently large farm. And Stettlemyre, over time, watched his father run this farm. Evidently, Stettlemyre's father appears to have been a very smart, shrewd guy. But everything that happens on a farm, if you think about it, involves an auction process. Whether you are buying cattle, or you're selling cattle, or you're buying feed, or you're selling crops to be turned into feed, or you're negotiating for a piece of land, etc. It's all an auction process. And Stettlemyre learned from his father the process of negotiation in an auction market. And so Stettlemyre goes off to school, goes to Berkeley, gets a degree, and heads off to Chicago and begins trading, much to the consternation of his father, who wanted to have a real job. But anyway, Stettlemyre persists, and he ends up on the floor. And he's down on the floor, and he begins to pay attention to what's going on. And he very quickly discerns that what is going on the floor is the same auction process that he was familiar with from having worked with his father on this farm. And that you had a range that would establish itself, and within that range each day you would have areas of value, and those areas of value would be relative value. You would have areas of greater value than others. And it was in the areas of greater value where most of the trade occurred. And that's the natural function of an auction market. The purpose of a market is to facilitate trade. Trade is going to be, and this is logical, that's something else. This is a logical process. You can always default back to the basic precepts of this, and it's consistent in any time frame. Remember that. So trade will naturally occur because the purpose of a market is to facilitate trade. The purpose of an auction market is to allow buyers and sellers to come together to negotiate a fair price based on the needs of the buyer and the needs of the seller. And there's a trade-off there. But most trade is going to occur where there is the greatest consensus of value in a given time frame. And so Stettlemyre recognized this process. And in his mind, he sort of saw sort of a bell shape forming, because you would have these areas of greater value, and then you would have areas above that where not much trade occurred, and you'd have areas below that area of value where not much trade occurred. And you would have price that would tend to regress to the mean of what was value as determined by the buyers and sellers in that time frame. Now, remember, back in the 60s, actually until the 1990s, we didn't have electronic immediately reported volume in all markets, actually the late 1990s. And back in that period of time, Stettlemyre started thinking, and Stettlemyre became the head of the Chicago Board of Trade, and being the incredible visionary that he is, he said, well, now the floor has this tremendous advantage. And back when Stoudemire was trading, everything went through the floor. Actually, everything went through the floor until electronic trading began back in the mid to late 1990s. It really started to take over. But back in the day, so to speak, until the 1990s, the floor ruled. Everything went through the floor. The floor was the source of all information. The floor was where the only people that knew who was buying and how much and where. The public had to wait at least a day to get that information, which was collected and disseminated by the exchanges. And so Stoudemire was sitting down there on the floor thinking, well, now we would have more participation in these markets if we were more transparent in the information we had. So how could the Board of Trade, he was interested in actually in the Board of Trade, how could I come up with a methodology that would give the public information that the floor has? And so this gets back to his being able to visualize in his mind the auction process, that went on the floor, of having areas of relative value that formed every day where trade was facilitated, and as a corollary, areas of less relative value where trade was not as facilitated. So you had areas of fair value and you had areas of unfair value, unfair above, unfair below the area of fair value. And when a market would reach one of the areas of unfair value above the market, say, the market would not stay in that area very long and would move away from it very sharply back towards the area of greatest value, because that's where trade was being facilitated. The same thing would happen if price would go lower. It would go lower, you'd run out of sellers, the market would quickly regress back towards the mean, which is typically the area of greatest value. So Stoudemire, that's what created the profile graph. Now, Stoudemire took this concept and formed the early profiles and divided each time frame into letters. We'll get into that a little bit later. But the gist of his early work was that there were 4 day types, and then what happened after the first hour of trading could predict, what probably would occur the rest of the day, and that today's day type, in other words, Friday's day type, would predict what would happen on Monday. And his work was also very heavily influenced by attempting to identify the activity of the CTI groups using Liquidity Data Bank of the CBOT and where they were trading. Now, there were 4 CTI groups. Let's see, I think I have it bookmarked here to tell you what they were. I used to know, but okay, here you go. CTI 1 were floor members, CTI 2 commercial clearing members, CTI 3 members filling orders for other members, and CTI 4 members filling orders for all others, public and types of traders. Now, this is also information that was disseminated by the Board of Trade a day after the fact, so you could tell where the commercials were trading or had traded and where the public had traded, and that was information that could be useful. Well, that's no longer, this is one of the things that is no longer relevant because the categories have been morphed. But the takeaway from this is, the important point is that what Stoudemire was doing was trying to identify where the group that had the most money was and what they were doing. Were they buying? Were they selling? Were they at the upper extreme of the range, the lower extreme of the range? And by having this information, it was thought that you could divine what the market was in the process of doing and would do the next day. So that was sort of the gist of Stoudemire's early thought process. Now, something else about Stoudemire's work. So Stoudemire posited this idea that you could take trade activity, you could organize it in a graph, and it would be predictive. And he explicitly states that I have articles back from the 80s, and I have his early books that are out of print that's basically say, if this happens, this is what you do. Well, this created an incredible buzz in Chicago among not only, well, primarily the Board of Trade members, but also the public. The public was not as active in trading as it is today, but there have always been traders out there in the public domain, and they were really flying by the seat of their pants. They really didn't have information. This was before computers were ubiquitous. And so what happened is Stoudemire started this service. The Board of Trade published the CBOT Market Profile Manual that contains Stoudemire's initial concepts and works. And Stoudemire started schools. And along the same time, what you had was Stoudemire was at the Board of Trade, and another gentleman. There were two other people at the Board of Trade at the time. Jim Dalton, and you're familiar, excuse me, with his work, Mind Over Markets. And Jim Dalton was a discount futures broker, and he was at the Board of Trade. And then there was a guy named Don Jones, and Don Jones was a trader at the Board of Trade. Don was trading a hedge fund, and Don. Dalton was a broker, and Don was a trader, and Don's actually a scientist. He worked in the aerospace industry. He's trained as a physicist. He worked in the aerospace industry, and no point getting into his entire biography, but he gravitated to trading and traded a hedge fund for 10 years, and his hedge fund over that 10-year period of time averaged return of 50% a year. And then it stopped working, and he shut it down, and he got into research. Well, this was about the time Stoudemire came out with his concepts that what Don had been using, his system stopped working, and he shut his fund down. But he found Stoudemire's concepts intriguing because having a quantitative mathematical mind, this Gaussian shape that the profiles tend to form catches anyone with even an elementary exposure to statistics and what looks the shape of a normal distribution, normal statistical distribution will catch your eye. They call it Don's eye. And then he read with interest Stoudemire's theories about this. And Stoudemire's an extremely bright guy, but he's not a mathematician or statistician. And so what happened is there became a tremendous demand to get the information in the format that Stoudemire had devised. In other words, the profile graph. Well, you didn't have computers then, you didn't have charting services, and you had to get this information from the Board of Trade. Well, Don, who is still to this day, Don's in his 80s and still programs on a mainframe computer. So Don was capable of taking the information from the Board of Trade and producing these graphs. And so Don had all these customers that were customers and students of Stoudemire's that were going to these schools, and he was creating, pardon me. So he was creating this service that people were subscribing to, that they had to have to get the profile so that they could look at Stoudemire's day types and they could see where the CTI traders were trading and all this information. So Don Jones is getting this information and builds a business, basically a data business surrounding the business. And what he finds out is, and Don buys into this concept. He thinks this is the greatest thing since sliced bread too. And so what happens is he has all these customers, and then he begins to discover that there's a relatively high, actually a very high attrition rate among his subscribers. And so he does a little homework, and he finds that people are trying to apply these concepts of Stoudemire's that sound so great, and they just can't do it. They can't figure it out. Now, I'm going to read you an excerpt from Don Jones's book real quickly here. Stoudemire and a partner started Market Logic School, a
a system of market analysis based on profiles, was taught by Market Logic School and separately by Dalton Capital Management. That's Jim Dalton. Hundreds of traders were drawn to these courses by the promise of learning how futures markets could be understood and mastered. The Dalton Group initiated a biweekly research report under the editorship of Eric T. Jones. As an aside, Eric T. Jones is Don Jones' son. These profile reports investigated all aspects of the market profile liquidity data bank, providing an unparalleled breadth and depth of information on this database. Students of Market Logic School and the Dalton Group demonstrated a willingness to do the necessary homework and study to understand profile theory. Many students continue to have difficulty in applying it to the market. Excuse me. Our company, Cisco, had the impetus to encourage and help traders because we were a source of the CBOT data. We interviewed many traders who stopped buying our data because they could not make profile theory work satisfactorily. They reported two main problems. Within the day, they were unable to project the day's action from the developing profile to its final form, and they were unsuccessful in predicting the next day's action from the previous day's profile. Now, what they were unable to do, those two things, were exactly what Stottlemyre was explicitly telling them they would be able to do. Now, think back to what I said about the reasons that most people fail trading. They find a guru, and some of them are, not all of them are just, the grifters that just are just, blatant liars. Some of them are well-meaning. But they find a guru, they buy into whatever it is the guru is selling. The guru is typically charismatic and very believable, and certainly Peter Stottlemyre is a very credible person and very believable, and is a real trader who's done extraordinarily well trading. So people believed in Stottlemyre, and they believed in what he said. And Stottlemyre could actually trade what he was showing people could be traded. However, it wasn't tradable by other people. There were a number of reasons Stottlemyre could trade and other people couldn't trade it, but that's a story for another time. But people could not trade Stottlemyre's theories as they were being posited. Now I'm going to read another excerpt from Don Jones. At Cisco, we felt that a database with 10 or 20 times the information in the daily summary had to be useful for market analysis. We also believed in the utility of the market profile approach. Consequently, in other words, Don Jones believes Stottlemyre. He believes in this approach. Consequently, we developed an algorithm to calculate day types. Profile theory argued for the significance of day types in predicting continuation. We felt that once we could generate day types under computer control, we could develop enough information to find statistically the conditions under which the day types could predict continuation. Now, Don Jones, being a scientist, did what I'm telling you guys to do. Listen to me and then prove me wrong. That's what Don Jones did. Don bought into Stottlemyre's concepts, believed it, then he had anecdotal evidence that it didn't work, and being a scientist and being able to program, which was a unique skill, especially for that period of time, he programmed it, okay? All right, so we felt that once we could generate day types under computer control, we could develop enough information to find statistically the conditions under which the day types could predict continuation. Our study was negative. Surprisingly, we found little or no correlation between day type and continuation. This point was the watershed in our research. It focused us to look outside market profile theory in our attempts to understand markets of longer time frame. It has long been known in futures research that markets have no day-to-day serial correlation. That is to say, even in trending markets, the probability that the next day will be up or down is about 50-50. On a day basis, the market's normal fluctuation, the daily range, is much larger than any underlying trend and since hides it. In other words, it's noise. Thus, it is clear that longer-term time frames are necessary to define the market's condition. Now, that last paragraph that I read to you is the difference between what we do and what everybody else out there using Market Profile is doing, with the exception of Don Jones. I have based Alexander Trading and continue to do so on Don Jones's work. I want to tell you that up front. Don Jones, and Don is a friend of mine. I've spent an enormous amount of time in person with Don, as well as I still talk with Don. Talked with him last week. Don is just a wonderful human being. He's just one of the most honest people I've ever met, and he does extremely rigorous research. And that last paragraph that I read to you is really the basis of everything that Don does, and it's also the basis of what we do. You have to look at this from a different perspective. You cannot look at it on a discrete day-to-day basis. And it's important for you to understand that, because it's going to differentiate what you're doing from what the quote-unquote other Market Profile traders out there are doing. These other people out there that are trading Market Profile are doing just that. They are trading Market Profile, and there's no validity to it. They are stuck in these past concepts. So it's important for you to realize what is valid and what is not. There's a tremendous amount of noise in terms of education. Again, put us to, we want your scrutiny, but learn to scrutinize everything that crosses your email box. If you start to look at something and it sounds great, do some work on it. Don't just drink the Kool-Aid, so to speak. Will save you untold fortunes. So basically, Stettlemeyer's original theories include there were 4 day types. You could predict the market during the day. You could predict the next day from the day. All right. Now, Dalton sponsored one of Stettlemeyer's books, because remember, Dalton was a broker. He was a discount futures broker, and he was interested in providing information for his clients to give them impetus to trade. It's a transaction model. And Stettlemeyer was very credible. What he posited made sense logically. And so what Dalton did, he basically took this Board of Trade manual and rewrote it and built a story around it and added day types. And he added some mechanical trades. And what Dalton did in Mind Over Markets very closely is basically Stettlemeyer's work expanded. Now, I'll tell you this. Dalton, Stettlemeyer, and Don Jones all had offices in the Board of Trade, and they all knew each other, and they all collaborated. Well, Jim Dalton is not a programmer and couldn't program. And so when he was writing Mind Over Markets, he went to Don Jones, who could program, and Dalton had some ideas about expanding Stettlemeyer's concepts of being able to predict the markets from a day-to-day basis. And he had these ideas about opening drive trades and this, that, and the other, and there's some mechanical trades in Mind Over Markets. And he's still he's still following that same track today. But back in the early 90s, as Mind Over Markets was being put together, he took Don Jones these ideas and said, "Hey, test this, and see what you have." And he'd take an idea to Don. Don would test it and say, "Well, there's no edge there. There's nothing there." And Dalton would say, "Well, what about this?" Don would take it back. He'd test it. "No, there's nothing there." Well, this process went on and on and on. And finally, Dalton stopped going to Don Jones because everything that he took to Don that he thought had validity didn't, but Dalton thought it did. So he put it in Mind Over Markets anyway, just FYI. Now, Dalton's book is eminently more readable than Stettlemeyer's work. And it sort of rekindled the interest in Market Profile that Stettlemeyer had kicked up in the mid to late 80s. When Dalton's book came out in the 90s, it rekindled the interest and seemed to connect the dots that Stettlemeyer had started. And it also provided the promise of being able to predict things with mechanical trades, etc. Well, there was a huge buzz about it, and so people said, hey, well, why don't you just trade my money? So they started a fund. Long story short, trading the concepts that are in mind over markets. And that fund shut down within a year because Don Jones had already told him the stuff wasn't valid. And then in real time, he thought, well, I can trade it. In real time, it didn't work, and they shut down the fund. So this is some of the background that, I have accumulated over the years of having been around as long as I've been around and knowing the cast of characters involved here. And I'm good friends with Don Jones. So this is information you're not going to hear anywhere else. Now, this is interesting. This is from an interview in Active Trader magazine with Stottlemyre in September 2005. The interviewer asks the question, what would you say to traders who are using Market Profile as a visual display on different charting platforms and are studying your original theories? It's a pass-through cost. It won't be very helpful. It's not an asset. Now think about this. I mean, this is information that's in the public domain, but it gets back to the bias people have of seeing what they want to see and hearing what they want to hear and ignoring everything else. Stottlemyre 6 years ago told people, look, this stuff doesn't work. It won't help you. Now, to this, Stottlemyre has moved, and actually what Stottlemyre is doing now is much closer to what Don Jones is doing, interestingly enough. I have studied Stottlemyre's new work. Stottlemyre has software called CapFlow. I leased it for a year. It's very expensive. It's clunky. It's convoluted. It's not tradable. The concept, like so much of what Stottlemyre's work has been through the years, is brilliant. Stottlemyre's visionary. There is application there, but you've got to really be able to read between the lines to get any value from it. And for my money, it wasn't worth it. But it's interesting, and the point of this is that Stottlemyre has taken these original concepts and they've evolved. But Stottlemyre is different than Don Jones. He's not he's not as scientific and as linear in testing things. And this is as explicit as I've ever seen Stottlemyre saying, well, everything basically that I had written before doesn't work. Now, that's not exactly what he said, but effectively it is. So most people out there are still trading Stottlemyre's early work. And Stottlemyre himself here is telling you it doesn't work, so don't trade it. And that's what I'm telling you. What we're doing at Alexander Trading is to take the things that Don Jones has taken and proven work, and we're trying to translate them and improve them in a rigorous fashion. And I've got, in a minute, I'm going to give you Don Jones's, well, here, I'll do it now. I'll put it up here. But this is Don Jones's website, and it's a treasure trove of valid information. It's a nightmare to get through, but it's worth it if you put in the time. So Don Jones's contribution to auction market concepts is that he really redefined Market Profile into auction market concepts. There is an implicit nod to auction markets throughout Stottlemyre's work, but not in the way that Don Jones did it. And Don Jones has basically said, look, you can't take a discrete event of one time frame and ascribe predictive powers to it. What you have to do is look at a much larger auction, a much larger development time frame before you can get anything that is valid and stable enough from which you can derive an edge. And he basically, Don disproved the nonsense and proved the more important concept. This is Don's website. I would encourage you to order his book. A lot of it's dated, but a lot of it's good stuff. Value-based power trading. I recommend anyone that is involved in this to get that book. And actually, you can go to his website. And here's this is typical. I'll give you a story of Don Jones. I've got a million Don Jones stories, but I'll give you one. This is how Don thinks. If you call Don and say, Don, I want to order your book, he's going to say, well, you can download it from the website. It won't cost you anything. Well, I'm telling you, don't do that. It's a pain in the butt, and you'll have all these loose leaf pages. Just buy his book. I don't know what it costs, but it's worth it. And say no, and tell him that Tom Alexander said, no, I want to order your book. But just talking with Don Jones is a treat. So go to his website, get the numbers on there. He'll pick up the phone and say, I want to buy your book. So he's a great guy. Okay, now we're going to get into understanding the auction market process. About time, huh? But you can't understand, I don't think you can understand the auction market process thoroughly unless you have the background information of where, because there's so much buzz about market profile. You now know more than 99.999% of the people about the genesis of market profile and the genesis of the auction market process and where it came from. So understanding the auction market process. Let me see. If you guys, I'm not caught up. I guess you guys don't have any questions. I don't see anything. Okay, good. Excuse me. This is what Stellermeyer saw on the floor. He saw when the day would begin, he saw the market begin to trade, and it would establish a range. And within that range would be areas of relative value. And the area where most trade was occurring was the area of greatest value, and that typically occurred near the mean of the range of a given day. So if a day is an auction, and it is, because again this is a fractal process, that auction would establish a range relatively early on, and then it would trade throughout that range during the day as buyers and sellers did what they're supposed to do, what they needed to do. They needed to buy and sell for various reasons, for different purposes. Not everybody that's in the market is buying or selling for the same purpose or in the same time frame. Otherwise, you wouldn't be able to trade, because everybody would have the same idea, and that's not tradable. That doesn't create a tradable environment. If everybody has the same opinion and the same need in the same time frame, you don't have a market. So what would happen during the day? Stellermeyer would envision the area of greatest value would be here. This would be an unfair high price level. Price would not stay in this area for long. Price would not stay at the low area for long. You need to know this. This is important. As simple as what I just said is, this is the basis of everything that we're going to do going forward. In a given auction, there's an area of greatest value. There are areas of of least value, above and below the auction range. So we want you to base your trading on market structure and on information generated by the market itself. You want to be trading as close to the market as you can get. And you can't get any closer to the market than understanding what the buyers and sellers are doing. Thanks to electronic trading and electronic dissemination of volume, you can see within a fraction of a second after it has occurred where volume has occurred and how much of it has occurred. That's incredibly valuable information if you understand how to put that information in the proper context. The profile graph, understand this, is just a graphical, it is a graphical representation of market development. It's not the only one, it is one of the ones. But it is a graphical representation of what is being played out in the auction market between the buyers and the sellers. An auction is a price discovery process between the buyers and the sellers. Bids and offers are made between the buyers and sellers until they reach an agreement on price. Somebody just, okay. So bids and offers are made. Prices that are too low won't have many sellers' offers. Prices that are too high won't have many buyers or bids. If prices are too low or high, they are generally unfair to the buyer-seller, and it won't do a good job of facilitating trade. So price will gravitate to the area in which there is the greatest agreement on price. And the profile graph displays this process of market development. The area of greatest value is the area where where trade most easily occurs between buyers and sellers, where large size is easily absorbed. It's a very logical, very, very logical process. Now, if you look at this shape, all right, this is a drawing, a representation. And here, these are actual auctions. This is a 5 or 6 day auction. This is a 3-day auction. But you have an area of unfair highs, an area of greatest value, an area of unfair lows, and then you have the same thing. And you have this occurring in all degrees of time all the time. But if you look at this, this is this. This is the information you're using. This is the information you're using. So if there is a holy grail in trading, this is from Stottlemyre. Time plus price equals value. And in other words, the amount of time plus the amount of time spent at a price equals the value of that price at that point in time. This is the closest thing to a holy grail of trading that you're ever going to get. This is knowing this and understanding this concept is infinitely more valuable than any oscillator or indicator or magic number scheme you can buy. So this is true. This speaks to the robustness, and you're going to see example after example of this. This is true in all degrees of time across all freely traded assets. And when I say it's true in all degrees of time, what I'm referring to there is it's just as valid on a 5-minute bar chart or profile chart as it is on a day chart, as it is on a weekly chart, as it is on a monthly chart. But it's also true across the spectrum of time from the 1929s, 1930s through today. The same exact process is in effect, and you can visually see that, and you can infer from the consistency of the visual shapes of that graph that's created through the profile and the auction process that the same stuff was going on in 1929, 1930 that's going on today. And will be going on tomorrow, as long as there are freely traded markets and we have access to where transactions occur. So, you've got all these people out there that are trying to model the present market based on fundamental metrics that have been turned upside down. But this has not been turned upside down. These concepts and these precepts are exactly the same as they have always been. Now, there are two. Remember when I started this, I said there's one thing you can predict in the market, and that is that there's a constant cycle between balance and imbalance, between horizontal development and vertical development. Okay, I see it's 11 o'clock. Let's take 5 minutes here, guys. Take a quick break. Excuse me. So, what we know we can predict, and the only thing we have to worry about predicting, and it's really not predicting. Well, it's identifying. It's identifying market condition, and the market is usually identifiable, or you're able to categorize the market into one of two market conditions: balance and imbalance. 95% of the time, you can quickly look at a market, and we're gonna do this, and see that it's either in horizontal development or it's in vertical development. When you can't tell, then it's probably in a larger degree phase of horizontal development. When a market is very volatile on the intermediate term time frame, that's a form of horizontal development, and that's a difficult market to trade. But for the most part, there are two basic market phases: balance, imbalance. Balance is synonymous with horizontal development. Imbalance is vertical development. And markets are in consistent transition from one to another. It's an ongoing development process. It's an auction market is dynamic. It's a feedback loop. It's a probing process. And each of these two phases have certain characteristics. And distinct characteristics. Hold on one second here. Excuse me. Vertical development is each of these two phases have personalities. And the personalities, remember, everything, this builds on itself. Everything that I've said before now applies to this. A market that is in vertical development is a type of an auction, and that specific type of an auction has a personality. Vertical development or imbalance is a market in which the participants can't agree on value. There's no agreement. And one side or the other is overwhelming the market. In other words, the buyers are in control of the market, and they're overrunning the sellers, or vice versa. And markets in vertical development are looking for value. They're searching for value. They can't find it. Vertical development is abnormal. Vertical development, markets that are trending are inefficient markets. They're not doing what they are designed to do, which is to facilitate trade. It's difficult when a market is going higher and higher and higher to find the consensus value. Markets tend to most price change occurs in vertical development. Markets spend most of their time in horizontal development, and that's true. I'll give you an example, and we'll look at some of this. But even in the incredible bull trend that we've had off the March 2009 low in the stock market, it's been as vertical and as directional as almost any bull market in history. But it, believe it or not, you can prove this, has spent most of its time in horizontal development, just in a narrow range. Now, vertical development is the phase of development where value is known. An auction that is developing horizontally has an upper extreme, a lower extreme, and an area that typically forms near the midpoint of that range of an area of greatest value. And so the market constantly is transitioning. Well, once a market reaches a certain level of what we refer to as maturity, and we'll get into that concept later, in terms of balance, it will transition into imbalance. Knowing this concept, trading this concept begins with recognizing in which of these two phases the market that you're trading is in. Is it in vertical development or is it in horizontal development? Because you trade a market in vertical development differently, or you're looking for different things. Your strategies and your tactics are different in vertical development than they are in horizontal development. Certain strategies and tactics have more or less of an edge depending on which phase of development the market that you're trading is in. And that is a very important point. Yeah, Daniel, I think I answered your question there. Yes, the market spends much more time in horizontal development, but that can be deceptive. You have to understand that. The stock market has spent more time since the 2009 low in horizontal development, but that those periods of time where it's developing horizontally have been relatively contained in terms of range, and you've had tremendous price change vertically. We'll talk a little bit more about that later. So you've got vertical development and you've got horizontal development. Now, I'm going to show you some different markets and some different time frames. These are profiles, these are auctions of the S&P. And these happen to be one-year auctions. In other words, this is everything that occurred in 2004, 2005, 2006. It's very clear, it should already be clear to you, that this is an auction, and it has a range. It has an unfair high, an unfair low, and an area of greatest value. And it transitions into the next auction. But what is happening to value here? Value is moving higher. It is the migration of value that determines the trend of a market. Is it a bull trend or is it a bear trend? It's the migration of value and your intermediate to long-term time frames that define the trend of a market. And this is a robust process. You know, this is 2004. This is a very balanced profile. But during that year, there were weeks and there were days of horizontal development as well as vertical development. And the noise is filtered out in the longer term time frame to reveal a very balanced auction and in the larger degree time frame. That's what this concept does very, very well. It filters out noise and helps you to get as far away from trading the noise as possible. Most traders, as a matter of fact, almost all, especially intraday traders, are trading noise. They don't realize it, but they don't stand a chance because noise is randomness, and noise is normal. Noise is the normal state of the market. Noise is horizontal development. So there are only certain places that have an edge to trade. Okay, this happens to be, I just want to show you guys different assets. This is the banking index, and this is 2008. You can see the migration of value lower as the banking sector fell off the cliff. But you can also see there is rotation, even though this sector was effectively crashing. And if you understand this, you can go to a time frame above or below the one you typically watch when a market is trending in some time frame to get to know how to trade it, to apply the appropriate strategy and tactics. You know, most traders will say, you know, oh, the market's already up. I can't buy it. It's too late. I can't buy it. I don't know how to get in. It's too late. If I buy it, it'll go down. Or if I sell it, it'll go up. Well, using this, because this is a robust process, it will help you identify the phase of the market and then understand how you can get in that phase, especially in a phase of vertical development. Okay, here are monthly profiles, from July 1928 to July 1930. Again, you've got the Gaussian shapes that are formed through this auction process. 1932, 1933, you've got the same process. Now, these are 30-minute profiles. All right, these are, you know, you've seen some of these profiles that I've shown you are quarterly. These are actually years. This is this is a quarter, I'm sorry. But I've shown you several auctions that are chronologically organized into a year. These, each individual set of letters here is a 30-minute time frame. You've got the same exact, this is June of 2009. It's S&P Mini in June of 2009. This is May 8, 2009. And each one of these groups of letters is a 30-minute time frame. This is what is so exciting about the possibilities for you. Hopefully you're sitting there and the lights are beginning to come on. Hopefully you're understanding how robust this is, because you're seeing this auction process that creates this visual artifact very consistently. The process itself is consistent, so it produces a visual artifact that's consistent. And you use the exact same concepts to trade this time frame as you do any other time frame, smaller or larger. And it helps you determine if you should take a trade or not. Is this a tradable structure? I know what it is. I know where unfair value is on both sides. I know where grace value is. But is this enough information for me to trade? And it may or may not be in a given auction, but you can at least understand what's going on. Excuse me. Okay. All right. You looked at balance. Now this is imbalance. Imbalance is a trend. It's a directional move. Now this happens to be each letter is a week. So the B's are 1 month. This happens to be 2009. This is February of 2009, because we bottomed in March. But you can see the vertical move down and then the vertical move up. That's imbalance. It's a market looking for value. Now, each one of these letters is a week. Each one of these letters is a 30-minute time frame. And you can see the same process. This is imbalance in this time frame. This is imbalance in this time frame. This is imbalance in this time frame. So you've got 2 hours of imbalance here. You've got 90 minutes of imbalance here. You've got 60 minutes of imbalance here. So you're using the exact same concepts regardless of the time frame you trade or the asset that you trade. So it is a fractal process. A larger degree of vertical development, in other words, a weekly phase of vertical development, will host smaller degrees of horizontal development, which in turn will host even smaller degrees of vertical development, and so on. And you just saw that explicitly. Daniel, Giampolo, all right, let me stop here. I've got a couple questions. You say, I don't like your questions. I've answered your questions, Giampolo. I thought. Which question of yours have I not answered? And Daniel, while Giampolo is typing out, I guess, you say you don't. We'll talk about the construction of the profile itself and the letters. The letters is just a protocol. All right, Giampolo, why do I call balance an auction? Well, an auction is a facilitation process bringing buyers and sellers together. Vertical development is one phase of an auction, and balance is one phase of an auction. The auction itself is the interaction between buyers and sellers. And there's a phase of balance, there's a phase of imbalance. Okay, so this is a fractal process. This is important, and this is what gives it such an or gives you the ability to build such an incredibly effective trading model on it. There are more ways than I'm capable of explaining to you about how to apply this, but it all comes back to the basics of this. And that is that you've got, it's a fractal process, and the auction process is involved in a 30-minute time frame and a 30-day time frame. And you use one time frame to understand and to give context to the other time frames. And in that, in turn, enables you to find an edge. Okay. Now this is a chart. This is each one of these letters is a day. So this is the first day of trading in October. This is the second day of trading, the third day of trading, etc. I don't know what the dates are, but this is October 1st. This is the second. This is the third, etc. Now, you got weekends in there, so I don't know. But the market in let's see, 1, 2, 3, 4, 5, 6, 7 days traded 320 S&P points. This is an incredibly vertical move, is it not? Okay, so this is October 2nd through the 10th, 2008. All right, again, this is October 2nd. This is each of the individual days. This is 1160. This is 840. All right, so this is a time frame. This is an auction in this time frame. These are individual auctions, but they're all, more importantly, they're pieces of the bigger auction. Now, Daniel, you before, when you said, you posited the question, you asked the question, is it true that the market spends more time in horizontal development than vertical development? The answer is yes. The market, during this incredible, basically, a lot of people consider this a crash. I mean, it's tough to argue that 8 day, let's just say it was a lot of selling in a short period of time. You had 320 S&P points in several days. So this was an extremely directional move. But the reality of this is that most of the time during this period, the market spent going sideways. Would you believe that by looking at this chart? Well, here's what it looked like. Here are those 1, 2, 3, 4, 5, 6, 7 days. Most of the price change that occurred that is so vivid from this particular chronological organization of the trade activity, which is a day-to-day basis. When you break it down into individual days, now each one of these letters is 30 minutes. So Daniel, the B is the trading that occurred from 9:30 to 10 o'clock, the Eastern time. The C began trading at 10:30 to 11 o'clock, etc. So each one of these is a 30-minute period. And the market fell. This was 1160 down to 840. But look, most of the time in the market in these 7 days was spent going sideways, wasn't it? So while this move looks very dramatic, you'd say, well, nobody could trade that because who's going to sell it here when it's already down, 200 handles or 200 points? Well, you had a ton of opportunities to enter this market long. There were rotational trades up, but if you were smart, you were trading from just from the short side as this was occurring. There were numerous opportunities to enter the market with a defined amount of risk as it was effectively crashing from 1160 to 840. That's the power of this fractal process. Daniel, forget the A. It's just the protocol that my software CQG. You could most of the software that you get that configures. Here, let me post your question so people will know what I'm talking about here. You know, you can set up in your settings which time period you want for which letter. The CQG protocol keeps the same letters for the same time periods because the 9:30 to 10 o'clock is the same in bonds, notes, gold, the S&P. Most other software programs do begin the day session with an A. So, you know, there's no magic to the letters. It's what the letters represent. So what you have here, this is the day view. This is 1160. This is 840. This looks very vertical. But when you go down and you break it down into what actually happened during the trading session, this is what was going on. You had this auction process. You had trade facilitation. You had price discovery occurring all the way down to here. That's what makes this concept tradable regardless of market condition. That's why you can trade a market condition that has a VIX of 10 and use the exact same concepts to trade a market condition that has a VIX of 80. Giampaolo, market structure are the pieces of the market. It can be a 30-minute rotation. It can be a 5-minute rotation. It can be a one-day rotation. It can be a weekly rotation. They're the smaller pieces that form the pieces of market structure are the minor auctions that form the bigger auctions, that form the larger development phases of the market. All right, now this is a tiny time frame. These are 30-minute periods divided into 5-minute rotations. These are 1-minute profiles. So you can go down, you can see this auction process in effect down to time frames that you can't trade because it's not efficacious to do so. But the same process is in effect. Okay, it's a fractal process. So what? Hopefully, you understand this. If you don't understand the benefit of the fractal process, let me know now, because this is important. Do you understand that A, this is fractal, and B, why it's important? This is tradable information. Yeah, Roberto, that's exactly right. Roberto says, can it be said that noise is the market seeking value? Absolutely. It's the natural probing process of the market. Noise is trade facilitation, Roberto. Skip, you don't understand what. I'm just asking the question. I don't want the tone of my voice to throw. I just want to make sure I understand. You don't understand why. What is it you don't understand? Why? You don't understand why it's important to from a practical perspective? Okay, that's fair. Let me do this. and this gets into a little bit. We're going to jump ahead, but since I'm the one that threw it out there, I'm going to show you. All right, this is why, if you accept the fact that the market, if you accept the fact that this is a consistent phase of market development that occurs in all degrees of time, and that it has areas of defined value, this being unfair value, this being unfair value, and this being greatest value. Now, the purpose of this is to identify trade location, where you want to trade. And what we're trying to do, because this process is fractal, this could be so this structure right here, Skip, and I hope I'm not getting too busy with this, because it's a fractal process, you have a small structure here. And really what you're doing, you're trading regardless of time frame, you're using the same concepts to trade. So if I'm trading this structure here, basically what it enables me to do in an ideal situation is to trade the risk of this structure, but have the potential reward of the much larger structure. So if I have a market that, similar to the one that we saw in the example of 2008, where you had 7 days of the market going down day after day, you know, if I've been on vacation or something, and I come in and I look at my screen one evening, and I'm getting ready for the next day, and I see this market that looks to be in a free fall, then I can come in the next day and expect something like this to begin to form in a smaller degree time frame that enables me to trade this, where otherwise I would not be able to find acceptable reward to risk opportunity. So does that helpful? So that's the so what part. And we're going to expound on this, but this is important that you understand it's a fractal process. And you want to use the fractal process to help you fine-tune your trading. Giampolo, scaling down time frame. How do I define which time frame is tradable? Well, you can use, one way is by using EdgeCalc. You know, this is a process that that depends on more focusing on reward to risk opportunity. And I want to be trading a situation where I have a reasonable, consistently reasonable expectation of making 3, 4, 5, 6, 7, 8, 9, 10 times what I'm risking. So I can, while, whoops, hold on. So while it is a fractal process and it's occurring in all degrees of time all the time, to answer your question, what I have to determine as a trader is that even if I can find an entry here, if this is on a 1-minute chart and I'm risking here is it realistic to risk to here to make here? So if I'm risking 2 ticks to make 5 ticks, that's a 2-to-1 trade. But I have transaction costs. And the smaller you go down in time frame, especially into intraday trading, the less stable these structures are, the less reliable they are. So it comes down to measuring the reward to risk of a given auction or time frame that determines if it's tradable or not. Because just like I showed you, I can show you profiles on a 1-minute chart that look just like this, but it's not tradable. Now, it can tell you how the market is trading. It can identify the trend of the market in a larger time frame, but this structure itself on a 1-minute chart is generally not going to be tradable. This structure on a 30-minute chart or a 3-day chart or a weekly chart is tradable. But that's a pure mathematical equation. That's something maybe Harris can get into tomorrow with you a little bit more. Okay, so it's a fractal process, and the point is the same plan or setups can be used regardless of time frame. Here's an example. Prop shops are very popular. And the reason, by the way, and I'm going to get off a little bit on a tangent, the reason prop shops are so popular is because the floor is on its last legs. The floor is a dinosaur that's has a limited lifespan, and there are a number of people that traded on the floor for years and years and years that had a wonderful way of making a living because everything was driven through the floor. Well, that's no longer the case. Now, the day of the screen-based trader has arrived, and the guys on the floor no longer have the edge they had, if they have an edge at all. And that's another topic. But the point is, these guys now they've been traders their entire lives, and they're coming off the floor, and they're starting these prop shops. And these prop shops basically are an attempt to create an environment and to train traders to trade the way that these guys traded on the floor. The short of it is it can't be done. You can't trade off the floor the way traders used to be able to trade on the floor with the edge they had on the floor. And so that's why there are so many prop shops. And this frenetic trading that prop shop traders do is they're trying to emulate the function of a market maker as opposed to the function of a trader. And it's a different equation, and it doesn't translate to off the floor. But regardless of that, let's just stipulate that they could pull it off. It doesn't have an application outside that specific time frame. This does. As long as you have acceptable reward to risk in the time frame you're trading, the exact same setups can be applied, whether you're trading intraday or whether you're trading daily or you're trading weekly. Yes, Roberto. It is important to understand that noise is inverse to time frame. The smaller the time frame, the higher the noise. Exactly. Yes. But noise is what the market's supposed to do. Noise is the activity is the probing price discovery process of the market in the smaller time frames. It's a market doing what it's supposed to do. All right, now this is, I've talked about the importance of understanding the evolution of what was referred to as market profile into what we refer to as trading auction market principles. And one thing that still applies that from Stoudemire's early work is his concept, and this is something he visualized on the floor, was a basic 4-step process in the development of a market. Now, Giampolo, listen to this carefully. This may help answer some of your questions and explain some of the labeling of auction markets and development, etc. This is where this comes into play. Hopefully, this will help answer any confusion you have about that. So Stettlemyre initially posited that the market goes through a very consistent four-step process. You had a series of prices that was directional, up or down. The price, that vertical move up or that vertical move down, would at some point stop. Now, why would it stop? I'm going to explain this. I want you to understand the details, the backdrop, the minutia of this, because you will default back to it. It's important to understand the concepts. I don't want you to just rote regurgitate this or just rote try to apply it. To effectively trade this, you've got to understand it. You've got to understand the auction process. So a series of prices in one direction is a vertical move. It's vertical development. It is a market that is one-sided. It's a market that's looking for value, but it's a market that's one-sided. So that market will stop. Well, what causes it eventually to stop in that time frame? Well, it's a sign. It's a signal that the market is becoming two-sided. It's a signal that the incredible buying that's been occurring is now being met with some selling, that somebody's finding some value. There's a more rotational process. It's a more two-sided market. So that's why a market that is trading vertically stops. It's because it begins to become two-sided. The third step, as posited by Stettlemyre, was there would be development around that stopping price. In other words, development and auction are synonymous terms. An auction would form around that stopping price. Now understand that stopping price, let's say we have a vertical trend up, is seldom the top tick. It's more the price, the market begins to become two-sided and it begins to become rotational. And just because the price at which the market stops is exceeded during that rotational process doesn't change the importance of the concept itself. And then in Stettlemyre's initial concept, all right, remember we've got this vertical trend, then you would have what he referred to as a move to efficiency. In other words, you would have the entire range retraced back to the beginning of the trend, and it would fill in from low to high and form this nice Gaussian shape. Well, step 4, you can forget about. Sometimes it happens, sometimes it doesn't, but it kills a lot of traders expecting a certain thing to happen, which we'll get into a little bit later. But the first 3 steps in this are really quite a simple and elegant description of the auction process that is tradable to this day in all degrees of time. And it's important to understand it and to know it. Okay, this is the 4-step process as posited by Stettlemyre. You have a market that begins to trend vertically. And then you have this constant transition from imbalance to balance, notice. In step 2, the market, there's a stopping price. And the market begins to form a range near the upper extreme of this development. And then what happens is you get this Gaussian shape. And this auction itself has an extreme. It has an unfair low, an unfair high. And then in Stettlemyre's initial theory, what you would have then, you would have, and he called this a Stettlemyre distribution, where you had volume at one of the 3rd standard deviations, the upper, the lower standard deviation, and he posited that what you would have a migration of volume, i.e. value, back to the 1st standard deviation near the mean of the range, to get technical with it. But that's, you You don't have to understand that. But basically what he said was, if you saw this, what you would have then eventually would be a rotational process that would test all the way back down to the beginning of the range, and then this itself would fill in. So what Stottlemyre was basically implicitly stating here, or trying to illustrate, is a fractal process. But the problem is that this doesn't occur. Or sometimes it does, sometimes it doesn't. It's random. And we know randomness isn't tradable. But this is the four-step process. If you hear this alluded to, you'll understand where it came from. Now, it's something else to understand, and this is part of, and you see this today, the market profile traders, they see this and go, oh, that's a P. Well, if it's a P, it means it's short covering, and the market's going to trade down, so I'm going to sell this because I know the market has to go to here. Well, that's where the P stuff came from, the P and the B. This is a market that's trading higher. This is 3 steps that forms a P. And then you had the same concepts. All right, this is the P, all right? And the assumption was that you would fill in and you would bias your trades to the short side. And then you've got the opposite of that. You've got a B. And if you have a vertical trend down, then you'd have a stopping price, you'd have development, and you bias your trades up. There's still an attempt to trade this in a rote manner, and it does not work. There is no validity to this. All you need to worry about, all you should worry about, is identifying steps 1 through 3. That's tradable information. You don't have to guess that it's going to break up or down. Now, we're going to share with you later, either today or tomorrow, there are times that you can make a logical assumption about the break of a mature profile, but it's not because it's going to form some magical shape of a P or a B, or it formed a magical shape in a P or B, and you're going to get some sort of regression back to the entire beginning of the range. That's important. And that's a lot of the nonsense that's still out there today that people are trying to trade. And it's also why nobody can trade quote-unquote market profile. Market profile is not tradable. You're not trading market profile. You're trading an auction process. That's why I keep going over all this minutia and detail. I want you to understand the concept. If you understand the concept, then you will trust in your trading, and you will trust in the ability to develop a trade plan that uses these concepts. If you just try to say, oh, I'm going to buy this because I've got this Gaussian shape at the end of this range, you don't know what, it's random, and you don't understand it, and it won't work. And you'll lose confidence in your trading. Okay, 4-step process. It's not magic. P's and B's do not always result in a nice, neat, Gaussian shape. It is a logical dynamic of an auction market. It's a dynamic process, not a mechanical one. Sometimes you get when you see the quote P or you see the quote B, the market breaks back to the beginning of the range. Sometimes you don't. That's the definition of randomness. You can't make a reflex assumption that a P and a B will ultimately form a nice bell shape. It misses the point, and it drags you back into the no-no of getting in a predictive mindset. Giampolo, yes, that's the short answer. Okay, let's talk about this. All right, this is an example, and this is the S&P. Now you have a B, right, and then you have a P form. Now we've got this node down here, we've got this node up here. Now this is what we're going to trade, and this is what's going to form, right? We're going to get this nice, neat Gaussian shape because that's what everybody does. That's what the trading room says to do. We know, got the B, we got the P, we're market profile traders. We're going to get this nice Gaussian shape out of this eventually, right? Well, okay. The next day we come in and another P forms. Now we've got a valley between, and this is something else that I get a kick out of. What is it? Naked POCs or virgin POCs. That's another attempt to turn this stuff into magic. It's silly, ridiculous stuff. There's a reason markets go to certain places. It's not magic. So okay, so we have a P here. We have two P's in a row. We have a naked point of control, and so we know this level has to be touched before the market can go higher because of magical forces out there in the universe, right? Well, then we get 3 days that form up here. So what's going on? Where's my magic? This didn't retrace and form a nice Gaussian shape, and I still have this magic level that has to be touched because the market can't go higher unless it touches it. But it did. Oh, okay. So now what we have these 3 days, and it looks like, gee, they may have formed an auction too. So this entire structure now looks like a P, doesn't it? So now the market's going to drop and it's going to form the nice fat Gaussian shape, right? So now, I know if I just keep predicting, that prediction will come to pass. I don't have to worry about all this other stuff about auctions and probing and what buyers and sellers are doing. All I need to know is P's and B's. Well, okay. What happens is, instead of, we've got an auction that forms here, and this is a P, but gosh, it continues to trade higher and higher and higher. So the point of this exercise is don't get stuck believing in magic and being a rote market profile trader. You're not a market profile trader. You're trading an auction market. A lot of the old canards are just that. They're old canards and they don't work. And people are still using them. But that's great. I mean, we can use the liquidity. No, Daniel, it's absolute nonsense. That guy's making the same attempt to turn this into magic. He's just putting his magical spin on it that Dalton did with Stottlemyre's work to turn Stottlemyre's work into magic. There is always somebody out there that's going to turn something that has some sort of underlying basis in validity into magic because that's what sells. Magic sells. Understanding the process and really understanding and working at it is hard work. And people, traders don't want to work hard. Otherwise, what would they do? You didn't get you got into trading to get rich quick. You didn't get into trading to work hard. Unfortunately, there is hard work in trading, right? So this is what can happen to you. Now, this is 7 months of P of value moving higher with no regression back to the mean. So you've seen in all time frames this nonsense about this fourth step is not going to magically appear and bail you out. And this is also something that destroys a lot of people that go into quote-unquote market profile chat rooms, because what they're doing, anything that moves two handles, they start fading. And the reason they do that, implicit in that, is they think there's going to be rotation back down or rotation back up when they're buying it. I guarantee you, there are market profile rooms that bought the market all day long Friday because it had to stop and rotate, and that will bail you out most of the time. It'll bail you out 5 out of 6 days, but on that 6th day, you'll lose 6 months of your trading capital. And here's your 4-step and Bs. I mean, it's the same thing. You can't assume a rote mechanical application of this. You have to understand the process. You have to understand the migration of value. Now this gets back to, and I want to remind you of this again, that's why it's here again. I know we've had this. Stoudemire is telling you himself the initial market profile concepts that are in his early work and in his books don't work. He learned that and moved on. And he left everybody else in the dust. So here are the basic concepts. And Daniel, I think it was Daniel or Skip, one of you guys, 20% of the time markets tend to, and this is anecdotal, I haven't done any study on this, but most of the time the market is in horizontal development, even in strong trends. You saw that example back in October of 2008 when the market was effectively crashing. And then 80% of the time the market is in balance or is horizontal development. And as traders, what we want to identify is this in some time frame. I can say this unequivocally. I don't care. And some of you guys, I'm looking on here. Some of you guys are in the advanced trade rooms, and this is as much for you as it is for the new guys on here that are hearing this for the first time. You have to be able to identify this in some time frame to execute your trade, or you're not trading auction market concepts. You're guessing. This is what you have to find in some time frame. This is the only thing that's been proven to have validity, is the balance concept and the fact that there is an edge taking initiative trades and responsive trades once a balance area has been identified. It's both that simple in terms of being able to state it. Now, as you guys know that have been with us for years, it's not that simple in application, but it is that simple in concept. And if you understand all this minutia that I've been putting you to sleep with up to this point, it is important that you understand that. And if you understand that, then you understand why this is important, and you will, by the time this seminar is over on tomorrow afternoon, have a grasp of how to apply it. But I don't care what time frame you trade or how sophisticated a trader you are, you have to default back to this concept. And if you don't, you're trading randomly. Daniel, you ask a great question, and this is the question that everybody asks. It's a fair question. It's a question that has to be answered. I'm going to read it. Does it matter what time frame? You said a minute doesn't work. What about 3 or 5? How do you know what time frames to look at? That's a question that doesn't have one answer. The closest thing to one answer that I can give you is that whether or not this is tradable depends on whether or not you can objectively determine a reward to risk that provides a positive expectancy. And while you will see this on a 1-minute chart, it's not tradable on a 1-minute chart because the distance between one extreme and the other extreme is not enough to give you an edge when you factor in the risk that has to be assumed plus the transaction costs that's required to take the trade. Now, when you get through to tomorrow, I think, and I'm quite sure that didn't answer the question for you. That is the answer, but there's more information that will help you understand that answer. Giampolo, yes, and we're going to talk about that is the short of it. Yes, you have described a basic, a very important concept, and the short answer, the direct answer is yes. Okay, here are the basic concepts. You've got three primary levels and a balance area. You've got an unfair high price level, an unfair low price level, and an area of greatest value. When you reach an unfair price level, you can expect a sharp move. When you reach the area of greatest value, you can with certainty know the market is either going to rotate to test the unfair high price level or the unfair low price level. Now notice I didn't say anything about direction. This is a methodology that focuses on identifying market condition. This is a market condition. This is a market condition of balance. And it depends on identifying trade location from where the area in which you want to be taking trades. There are only certain areas in a market that give you an edge to trade, whether you go long or you go short. And if you trade only from those areas, you have an edge regardless of whether you go long or short. So these are inflection points. The unfair highs here, the unfair lows, and actually the high volume node. It's also an inflection point. These are areas from where it is very likely the market is going to move sharply. And what happens near these areas is important. And it's important that the trader, you guys, learn to spend your time and attention focusing on what happens when a market trades into these areas. You know, something about, and this is something I hear from our clients all the time, and it happens quickly to new traders that come to us. They'll say, you know, my trading is much more relaxed. And it's relaxed because so much of the anxiety is taken away, because you know that most of the time your job as a trader is to do nothing. Doing nothing is great trading, because most of the time the market's not in a position that gives you an edge as a trader. And so if you understand this concept, you're sitting there and you're just letting the market chop around and whip around and enrich CME stockholders, and you're just sitting there waiting for certain specific opportunities for price to reach certain levels based on a bigger, much more sophisticated understanding of market development. You're waiting for the market to reach an area that's an inflection point where it is more likely than not to move sharply. Yeah, Raphael, I'll talk about that. I'm not ignoring your question. And closes, depending on where they occur, Raphael, are a measure of value in a given time frame. And quite often, and I haven't done much work on this, I'm just starting to look at this, quite often those closes will be clustered near a high volume node from a profile perspective. Okay, so the bottom line, this is what we're looking for. We're looking for this on a monthly, daily, 60-minute, 30-minute, 5-minute, 1-minute time frame. Just because you can't trade a 1-minute time frame doesn't mean that you can't view the market this way and get information that can be useful in determining, okay, here's what the market's doing, here's where it's migrating in this time frame, etc. It gives you a perspective. It gives you a way to view the market, even if it's not tradable. All right, let me catch up. I'm behind here in my slides. Okay, it's 12:07. Let's reconvene at 12:50. So we'll take about 45 minutes, guys, for lunch. Okay? Hey, Harris, do you want, I guess we'll stop the recording here and then start it again and we'll divide it up, right? Are you listening? Okay, guys. I'll see you in about 45 minutes.